Good morning, everybody. Mike Niemiec here with some early grain and oilseed news and grain comments for Wednesday, June 20th, the first day of summer. Kind of ironic, we are talking, one of the lead topics has been about summer weather, which we have ongoing right now. Trade was a little bit uncertain about world economic events, the Eurozone in particular, flip-flopping weather models. We also had private estimator come on out and raise planted acreage estimates. All that left the market somewhat in a depressed mode on Friday of last week. But within these past 2 days, we've exploded to the upside on weather ideas, crop ratings going down, what is our yield potential going to be, and off to the races we went, with the markets pretty much scoring new highs for the move. We kind of tamed it down a little bit last night. The soybeans were higher last night, 10 to 5 cents. The meal market kind of steady, the soybean oil market up 50 points, but most of those markets contained their highs of the move. Corn and wheat backing off roughly around a nickel as we speak. The market once again being generated by the weather forecast. Currently, we did get roughly around a half to an inch of rain where it has been raining in the northwest sections of the Corn Belt. We are going to have a system move on through that's looking to throw around a 1/4 to 3/4 inch of a rain into the northwest areas of the Corn Belt again. But as that front moves eastward, it's looking like it's going to kind of fizzle on out and lay less than maybe 3/10 to a 1/10 of an inch of rain. So the pressure is on to try and improve those yields. The rain forecast right now doesn't seem to be all that beneficial. A little bit of the extended forecast does look for somewhat of a breakdown of the heat that the Midwest is seeing. But as far as this northwest flow pattern that they're forecasting goes, not much in the way of rains are going to be generated. So the onus of the market is going to continue to think that perhaps crop ratings are going to continue to go down. The yields that the USDA is currently forecasting are somewhat suspect as being too high. The trade is out there maybe talking about a 160 yield for corn and a little bit smaller than the 43.9 yield that the beans are being currently forecasted by the USDA. And as we continue to work through that, obviously, everything else being equal, the carryouts come on down for both the corn and the beans. Corn is really not threatened yet unless we get much below 155. But the bean situation is different than the corn, which is also somewhat of a more important factor that's going on with the soybean complex. The soybean market is being supported by the fact that South America did not produce a big crop last year, and as a result, more and more businesses seemingly coming to the U.S. That continues to take down our row crop bean carryout. Our crush has been running stronger than what the USDA has been forecasting. Are we going to get the added bean acres at the end of the month? Is our yield going to be strong like the USDA? And was the USDA warranted in lowering the demand for next year, which is basically keeping our new crop carryout at roughly pipeline levels? And as an end result, also, we're continuing to see a South America bean harvest, their basis levels, particularly in Brazil, continue to explode, suggesting that either they're through selling beans, they don't want to sell any more beans, or they're quote-unquote running on out, putting them more expensive than the U.S., and now the need is for the U.S. to go and grow a crop as a result of this anticipated increased demand coming back to the U.S. We really don't have that story in the corn and the wheat. In the corn, as we rally the corn market, we've run into a couple stories on the wires that gets a little bit problematic. The ethanol margins for the corn starts to get a little bit negative. There's reports on the wires of where some of these ethanol plants are starting to shut down because of corn availability or the cash corn prices being too high to make margins profitable. And then we're also still with a South American corn crop as opposed to beans being cheaper than us and or Black Sea. So that continues to be somewhat of a fly in the ointment in the corn story as far as underlying support goes versus what we've seen in the beans. Another difference is, which is surprising, is that once again yesterday, even though we had the big blow up in corn, open interest was down huge again in the corn market to the tune of around 11,000 contracts. So we continue to see a dwindling of the open interest in the corn. No one is really seemingly embracing this storyline over the short term as far as yields and potential carryout going down goes for corn. But it is getting the beneficial buying interest in the beans. Bean open interest and meal open interest were both up yesterday in conjunction with, if not so much the weather story, in conjunction with this tight world supply situation and demand coming to the U.S. Not much to say in the wheat market other than the fact that world wheat supply numbers seemingly are coming on down as far as production goes, but we are harvesting a crop, and we are seeing farmers selling in the wheat market, which is evidenced in the weekly deliverable stocks numbers. But right now, corn and beans are seemingly taking the forefront of the storyline by the trade as opposed to the wheat market at this time. So anyway, we're a little bit easier in the corn and wheat. Beans look a little bit better. We were roughly in a $5 to a $5.50 range in Dees corn and $12.50 to $13.50 in the November beans. Yesterday's trade exploded us above those levels. So those are considered technical breakouts, and if we are going to get any setbacks in the market, we would imagine they'd be limited to the top end of those ranges as we await further weather forecasts and or demand updates. Once again, these are the opinions of myself, not ADM or ADMIS. Thank you.